Apple and Google both lose major court battles with the EU over taxes and antitrust concerns. Chinese equities close near a 5-year low as bearish sentiment grips the market, while European stocks waver as markets await U.S. CPI data. Plus, it's Trump versus Harris, while the Republican and Democratic presidential contenders prepare to face off for the first time in a live debate today. Now, also coming up, an exclusive interview with Pascal Soriot. He's the chief executive of Astrazeneca. We'll talk, of course, about what's in the pipeline drugs and some of the healthcare programs across the world. That's in about 10 minutes or so. First thing is first, let's take a look at the European markets map. Again, a little bit of a wobble. This is on the back of some concerning news from some of the corporates. You can see the FTSE down 0.3%. Overall, the CAC 40 is pretty much unchanged. The DAX over in Germany gaining 0.2%. I guess the market mood a little bit cautious ahead of some very important print. Again, investors looking to balance some of the U.S. recession fears and the likelihood of a soft landing. Now, a couple of companies that we're looking out for in pre-market, for example, Apple losing its court fight over a 13 billion euro Irish tax bill and a boost to the European Union's crackdown on special deals doled out by nations to big companies. Now, the EU Court of Justice in Luxembourg backed this landmark 2016 decision that Ireland broke state aid law by giving the iPhone maker an unfair advantage. You can see actually Apple down some 0.6% pre-market. If you look at Google, it's practically flat. Google has lost its bid to topple a once record 2.4 billion euro fine for abusing its monopoly power to crush rival shopping services. But actually, this was pretty much expected, so it's not having a massive impact. And then Oracle reporting actually better than expected quarterly profits. So let's have a look also. Oracle pre-market gaining 9%. The company says cloud services have become Oracle's largest business as quarterly revenue rose by 7% to $13.3 billion. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. It's Tuesday. Happy Tuesday. I'm Francine Lacqua here in London. Now, joining me to talk about data, inflation, and, of course, the markets, Grace Peters, Global Head of Investment Strategy at JPMorgan Private Bank. Grace, as always, thank you so much for joining us. We're definitely in a back-to-school mode. China's a bit of a worry. We're expecting a lot of data, and markets don't really quite know how to behave.
No, this feels uncomfortable, doesn't it? And I mean, our base case is still very much that we achieve the soft landing. And what I think the market is trying to determine is which of the tail risks, whether that be recessionary risks or inflation risks, are the dominant force. And so why I say that feels uncomfortable is a slowdown in the data is a slowdown in the data. We can look forward and anticipate where we think that slowdown ends. And for us, that's in trend-like growth for the US and modest disinflation. But it's hard to differentiate in these early days of the data slowing, where that landing point is.
But Grace, I guess, the million-dollar question is, does the Fed front-load a lot of these cuts? And if they don't, is that a policy mistake?
Yeah, I think there is going to be a degree of front-loading, and certainly when we look at what's priced into the market out to a terminal rate of about 3%, which I think is soft landing territory to us in 2026, you see a degree of front-loading, some 200-odd basis points over the next sort of 18 months or so. To me, that doesn't necessarily mean it has to start with 50 from the Fed when they start its cutting cycle. Our base case is that it's still 25, 50 is innately possible. Francine, I don't know if it matters to markets that much. I mean, this is still, the first cut. It's still going to signify the first of many cuts, I think. And it's right that the data, the Fed remain data dependent. So I don't feel they're behind the curve, but it obviously is time now to cut rates.
Yeah, I mean, there's a big difference, actually, with what the market is looking at and what chief executives are saying. And that's partly because there is, an obsession with the Fed cuts, the moving, but actually markets go this way. And then you have these bigger pictures, trade, supply chain issues, U.S. presidential election, China. That's not really being priced in.
Yes, I mean, second quarter earnings season was actually pretty resilient. Yeah. For the S&P overall, you saw 11% earnings growth, which is the best quarter we've seen really over the past couple of years. So I think the message from corporates, whether it be on earnings, share buybacks, capital expenditures as well to invest for future growth, all of that is pretty encouraging. But as you say, there is fragility that underscores that. Driving some of that capital expenditure are these fragilities around supply chains, political risk, geopolitical risk. And so there's a lot to navigate. But I think on balance, we think that this means balance in the portfolio is also critically important. So equities we still think are going to be the growth driver for portfolios, so that corporate earnings cycle is super important to us. But the fixed income complex, not just for yield but also for defensive ballast, as the Fed starts to cut rates, and obviously other central banks as well, is super important. And then let's not forget that we mustn't be complacent about inflation. So whether it be infrastructure assets or gold for some of those geopolitical risks as well, we think that is, a very balanced portfolio that will do well.
Where do you see complacency in the markets? And actually, when you look at, a lot of the equities, some of them are really priced to perfection.
Yes, I think so. I think the market has swung perhaps too far to worrying about recession risks, and particularly after, the summer jobs report that we got, the July jobs report. That swing was too far. And, as I say about those tail risks, that innately means to me that it's worrying a lot less about inflation. I do think, based on the data we see, that's right, but I think we shouldn't get complacent to say that inflation, the disinflation path may be bumpy, so that may not, also come to pass. And I do think that concentration risk is real. I'm not overtly... I wouldn't say that gives the whole picture, because when we think about just the concentration of the equity market, there's also... that's driven fundamentally by earnings, by capex, that's driving capital expenditures. And as long as a return can be earned on those capital expenditures, I think that actually that technology complex can do well. But I would argue for more breadth to the market as we go through the next 12 months.
And Grace, how do you see oil at the moment? So you could say that actually it's a bit of a stimulus for the world economy, or you could say the fact that it's fallen, not sharply, but it's fallen,
yes,
is the earliest indicator of a possible worldwide recession.
Yes, I think it has fallen, as you say, because of the China data, manufacturing generally being perceived to be weak. We actually think, below $70 WTI is an interesting buy level for oil. Our target is around $80, just below $80, looking over 12 months out. But obviously that's a key part of headline inflation as well. So this fall in the oil price will probably help bring headline inflation down over the medium term. But oil is the key transmission mechanism, I think, for many of these geopolitical risks. So when we're thinking about, when we start to worry how the market prices geopolitical risk premium, primarily we do think that will be through the oil market, and therefore having some exposure to that as a kind of hedge. Probably gold would be my preference, but oil could also be a way to access that in the portfolio.
Grace, when we hear some of, I guess, the campaigning policies that Donald Trump has put in place, which is, on the economy, like possible tariffs, possible trade concerns if you're looking to buy less dollars, how do you model that? And actually, the markets have been largely ignoring it. Is it just because we don't really know how it works out, or because it's campaigning noise?
I think the markets are of the view, which I would share, that it's policy over politics, first and foremost. And we've obviously, as we've just discussed, there's a lot going on the policy front, and trying to anticipate the extent of the cutting cycle and what that means for risk assets. And, of course, a lot of the politics is still unknown. What I certainly feel is that over summer the race has tightened up. There are going to be topics that we're watching. So tariffs, trade policy, taxes. When we think, immigration would be another one that we need to, see what actually plays out. And they all have the possibility of impacting markets. But I still think when we look back in history, markets go up because GDP grows, and if anything, the longer-term themes around AI and productivity gains have the potential to influence GDP more over the medium term, with an upward bias if we can actually harness artificial intelligence. So I think that's why the market's focusing on that. I would expect volatility, as we've seen since the start of August, to pick up. I do think that we're going to see more volatile markets, and for investors who can, to us, that means opportunities and structured notes that we would use to sort of monetize some of that volatility.
So interesting. It's true, these markets freak out. There's a big sell-off, but in 3 days afterwards, they're usually fine.
It is. We still think you can buy the dip. Equities, as I say, is still the growth drive of the portfolio. But yes, I think that volatility, that two-way tussle will prevail.
Thank you so much, Grace, as always, for joining us. Grace Peters, Global Head of Investment Strategy at JPMorgan Private Bank. Coming up, Astrazeneca has rallied to become the UK's most valuable listed company. But today, it's the biggest faller on the Euro Stoxx 600. Now, we discuss the headwinds facing the pharma giant in our exclusive interview with the chief executive. He's Pascal Soriot. That's coming up next, and this is Bloomberg. Everyone, now Astrazeneca recently became the first British company to reach a market value of more than $200 billion, or actually £200 billion, with a big bet on cancer drugs helping to drive a rally in the pharma giant. Now, shares lower today after a lung cancer drug it's developing with partner showed mixed results in a late-stage trial. Now, joining us for an exclusive conversation on that, but also much more, is Pascal Soriot, the chief executive of Astrazeneca. Pascal Soriot, as always, thank you so much for giving us a little bit of your busy schedule. Now, you published some disappointing results overnight in this late stage trial of a lung tranker, which you could still develop in the future. But are you worried that this will affect your numbers?
Good morning, Francine. It won't affect our numbers because actually, first of all, the study, I think it's important to remember, it was a study in second, third line metastatic lung cancer. That study is actually positive. And in the group of patients where we're looking to get approval, the so-called non-squamous group, we delivered a 2-month improvement in overall survival versus a very active standard treatment, Taxotere, which hasn't been beaten by any other therapy for the last 20 years or so. So a very strong set of results. Not as perfect as we would have liked. And of course, as a result, people are questioning what kind of approval we will get. We're always looking at targeting patients who will benefit the most, deliver the better risk-benefit. So we've also been developing an AI-based test that will enable us to treat the patients who will deliver the most benefit, the so-called TROP2 positive patients who have a receptor on their cells. So with this, we believe that we have a way forward and shouldn't really not affect our numbers in the long term.
So you still have this ambition of reaching $80 billion actually in sales by 2030. Do you think you'll get approval or some kind of other approval for this drug?
Yeah, I think we will get an approval. The question that people are debating is what kind of approval we get initially in second line. I think it's important to remember that the vast majority of the potential of this medicine is in the first line metastatic lung cancer, which we are developing right now. We have several studies. And we have really good hope and good reason to believe those studies will be positive. We also have presented at the World Lung Congress a study called NeoCOAST, which is in earlier lines again, that was very encouraging, very positive. So the big potential is in the earlier lines of treatment, and that is going very well. So that is not affecting our confidence in the drug. And beyond this drug, we have many others, of course.
Pascal, you're one of the industry leaders, of course, in oncology, but also cardiovascular and respiratory. What other areas do you earmark for growth? And do you have the internal capabilities of doing it alone, or are you targeting M&A?
Actually, we can do it alone, and our focus is cancer, of course, as we just talked about. And in cancer, we are developing a whole range of products, antibody-drug conjugates, bispecific immunotherapies. And importantly, we're also working very hard on cell therapy. And cell therapy is opening the potential to cure some cancers. We're also working on technologies like T-cell engagers, so a whole range of new technologies that will improve the treatment of cancer. Outside of cancer, we're working on cardiovascular disease, metabolism. We have a whole range of products to treat obesity and metabolic diseases. And then we're also working on respiratory immunology and finally on rare diseases. So you can see that our whole portfolio goes much beyond Dato, the product we were just talking about a minute ago.
There have been a lot of questions, of course, about your site in Liverpool. Has the government reduced state aid available for this investment?
We are still in discussion with the government. We are committed to this investment, but of course, we have to wait for the final conclusion of this discussion. I can't say much more at this point. It is an important investment for us in the UK, of course, an important investment for pandemic preparedness. But I can't say much more at this point.
Is the UK lacking incentives for manufacturing and R&D investments in general, or is this also something that's under negotiation?
I think the government has really been making quite a number of efforts to attract investment in manufacturing. The bigger issue in the UK, quite frankly, is access to medicines. Pharmaceutical companies want to invest in research and development in countries where they believe their medicines will be able to help patients, so they will be reimbursed and patients will be able to benefit. And in the recent past, access and reimbursement has become more and more difficult, not only for us, but for other medicines as well. And that's probably the biggest disincentive to pharmaceutical company to commit and invest in the UK.
Pascal, several Astrazeneca employees have also been detained in China in relation to 2 probes. Are you aware of AstraZeneca actually breaking any laws in relation to those investigations?
Yeah, it's something we take very seriously, of course. It's important, though, to remember the context of it. It's a small number, 8, 9 employees that are affected by this investigation. We have 12,000 field-based employees in China. It's a big country, as we all know. We are the largest pharmaceutical company in China. We have almost 17,000 employees, 12,000 in the field. So we are looking at a smaller number of people. We have strong policies, compliance policy. We train people. We, of course, investigate. But it's impossible to have a compliance officer being each and every one of our field-based employees. So we are working very closely with the authorities. And I think actually what the government is doing is not affecting us only, it's affecting other companies. And it's a good thing because we need to really make sure that we can operate in a very compliant environment in China, like everywhere else in the world.
But what are some of the key threats for AstraZeneca in relation to doing business in China, and how can you actually mitigate some of those risks?
Yeah, of course, we are all aware of the geopolitical tensions between the US and China in particular. So what we have been doing is, of course, follow the laws and regulations in the US, in China, everywhere. But also we've been building our supply chain in China so we can supply China from China and also supply some emerging markets from China. So we have several new investments, manufacturing investments in China for many of our new medicines. And in parallel to this, we're investing in the US. Recently, we invested in a cell therapy manufacturing plant in the US, in Maryland. So you can see we're building 2 supply chains that are going to be independent from each other and enabling us to supply China on the one hand and the Western world on the other hand.
Would you ever actually consider spinning off the business in China?
No, I mean, it's a very important part of our company. First of all, there are lots of patients who need our medicines in China, but also importantly, in the last 3, 4, 5 years, China has become a very important part of global innovation in our industry. There are lots of new medicines that are invented in China that we can license in or co-develop with Chinese companies that will benefit people around the world. So we believe that China will remain an important part of our company, not only because we sell there, but also because we manufacture, export, and also can source innovation from China that will benefit the entire world.
You mentioned the U.S. What do you need from the next president of the United States of America when it comes to healthcare?
Yes, I was listening to Grace Peters, who was with you a few minutes ago, and she was talking about policy. Essentially, we need policies that will support innovation in our sector, innovation in biomedicines, innovation in research and development. The US has been the country that has been driving innovation in our industry, in life sciences, for many years. And I believe will remain so for a long time to come. China is the other big driver of innovation. Unfortunately, Europe has been falling behind. So what we need is continued investment in basic research, We need a continued investment in biotechs, in startups, through private investment that is, of course, incentivized to invest in those emerging companies. And finally, we need, of course, access for our medicine. So that is really a key part of incentivizing pharmaceutical companies. Make sure that their medicines can actually help patients.
I mean, looking at your share price, where does the market most underestimate AstraZeneca?
I think the market underestimates the strength of our portfolio and the growth we can deliver over the next number of years. The pharmaceutical industry is not a very simple endeavor, as we all know, and it's not for the faint-hearted, and you never will have a linear development. You have ups and downs, and that's what we've had in the last 10, 12 years. But in general, we are moving in the right direction. We have a very strong portfolio, and people are underestimating several of the products we have in the portfolio and reacting to events that happen on a day, as opposed to sometimes looking at the long trend. Our long-term shareholders, they of course look at those events, but they keep their eye on the long term, which is where we can be in 2030 and beyond. And that is clearly a good place because we have good development plans and we'll continue growing.
So, Pascal, given the setback with Daiichi Sankyo, what are you most excited about of what's coming up in the pipeline?
Well, I should say Dato remains a very important product for us. It's a setback in time, even if it's a setback. I mean, we'll have to see what the FDA decides. But even if we had a more limited approval than we're looking for, we don't know what we will get. We have to wait for the FDA. But it's a timing issue because this new test we have developed will enable us to expand our presence and our use in second, third line. And then we have the studies in first line. And then thanks to this test, we'll go into other indications potentially. Breast, of course, but also many others. So Dato remains an important product. Our portfolio of antibody-drug conjugates is very exciting. Our bispecifics in oncology are very, very exciting. Our portfolio of products in obesity and cardiometabolism is also very exciting. Cell therapy overall, both in oncology and immunology, is very exciting. So there's a lot of products that really are going to change the future of medicine and drive our growth.
Thank you so much for your time today. That was Pascal Soriot, of course, the chief executive of AstraZeneca. So we'll keep a very close eye on what, of course, AstraZeneca will do in today's trading session, but also throughout the next couple of months. The other story we're watching out for is Apple. Now you can see Apple actually losing its fight over a €13 billion Irish tax bill. This, of course, is a boost to the EU's crackdown on special deals being doled out by nations to big companies. So you can see Apple is down 1.2% pre-market. Google is actually unchanged. Now, the EU's Court of Justice in Luxembourg backed this landmark 2016 decision that Ireland broke state aid law by giving the iPhone maker an unfair advantage. And then when it comes to Google, it lost its bid to topple a once record €2.4 billion fine for abusing its monopoly power to crush rival shopping services. Again, this was pretty much expected and priced in. No change in the share price. Coming up, Kamala Harris and Donald Trump prepare for a primetime debate. We get, of course, an overview on tonight's key election moments. That's coming up next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Apple and Google both lose major court battles with the EU over taxes and antitrust concerns. Chinese equities closed near a 5-year low as bearish sentiment grips the market, while European stocks waver as markets await U.S. CPI data. Plus, it's Trump versus Harris, while the Republican and Democratic presidential contenders prepare to face off for the first time in the live debate. Now, in a moment, we'll talk about the Apple and Google EU rulings with Matt Bloxham from Bloomberg Intelligence. We may talk a little bit about space as well, but first, Donald Trump and Kamala Harris are preparing for what might be the biggest night of their campaigns their first televised debate. Now, for more on all of this, we're joined by Bloomberg's EMEA News Director, Rosalind Matheson, who's here with us now. So, Ros, first of all, I mean, these things matter. I'm excited. This is like the best show on earth, but it matters to the voters, and we could see polls changing on the back of this.
Well, that's right. It's interesting because sometimes these debates don't matter. But as we've seen, for example, with the debate that happened between Donald Trump and Joe Biden, that proved to be very consequential for Joe Biden. And this one for both Kamala Harris and Donald Trump could matter because the polls are so close within the margin of error. And this is a moment to reach voters on a key thing, which is the economy, because we know there are several, 6 to 7 swing states, which could be, the ones that help decide this election. In those swing states, voters care about the economy. So what we want to see from this debate is really both these candidates laying out their stall on economic policy. Kamala Harris, who's perhaps less known, within America for her economic policy, what is she going to stand for in terms of certain tax cuts for support for people who are perhaps struggling with the cost of living in the US, needing help to get on the board with buying a house, for example. Some of that, we're going to see that from her. We're also going to see, how do they just face off against each other in the minute? It's an unusual debate in the way that it's set up. They won't be able to really go at each other, interrupt each other, and so on. Limited ability to do that. It's more like you say your thing, then I say my thing. It's quite an unusual debate. So how do they present themselves in the minute, with that?
And so personality-wise, I mean, Donald Trump's in the past been very much on the attack line. Do we know the strategy under, behind the Harris team, or how much does it have to do with personality? I know it's policy and economic policy, but actually personality is what a lot of people will vote on.
Yeah, very much so. And we've seen Donald Trump try a bunch of attack lines against Kamala Harris so far. He's called her a communist. Comrade Kamala is kind of a common one. But he hasn't really landed on something that seems to be resonating for now beyond his own base. And again, trying to draw those swing voters over. So what's the attack line that he's going to use in the debate to do that? And also for himself, the narrative now is about his age. Of course, like Joe Biden is out of the equation. So Donald Trump needs to present himself as agile, nimble, quick thinking in the minute, because those questions about age are now on him. And you say for Kamala Harris, it's about showing that she's got the policy heft, to be president, to lead on the economy and to speak directly to those swing state voters.
Yeah, it'll be interesting to see what they say on China. As always, Ros, thank you so much. Ros Matheson there, our Bloomberg EMEA News Director. Now, and also breaking news this morning, tech giants Apple and Google have lost their cases in the European Union's top court, putting them on the hook for billions of euros in fines. Now let's get more with Matt Bloxham from Bloomberg Intelligence. Matt, thank you once again for joining us. We have to also talk about Apple and the new iPhone 16. But actually, if you look at the share price, they haven't moved, but it feels like these court decisions are big and could be a blueprint for the future.
I mean, yeah, they're big, although I guess in the grand scheme of things, even the 13 billion euros against Apple, for a massive company like that, it's nothing yet, and it's been on its growth for a long time anyway. Yeah, I mean, I think you also have to put into context that these rulings reflect situations that are kind of 7-8 years old. Right. So from the European Union's perspective, if it takes you this long to impose stuff, then something's not quite right. And they recognise that. And so actually what you've got now is the Digital Markets Act, which is there particularly to kind of try to manage these issues that came up in the Google case. So I think, you don't think you can kind of put too much into these specific cases, but more about what's happened more recently with the Digital Markets Act, which is intended, A, to police these tech giants more effectively, and B, to get to the point of fining them more quickly. So I think that's the thing we're more focused on, and that's been playing out for the last couple of years or so.
So yesterday we talked about the Apple 16 and this, visual intelligence. Mm-hmm. Is it going to really drive a bit of an uptake for Apple, or not so much?
I think in the near term, probably not. I mean, inevitably, because it's the new phone, you're going to see a big uplift in volumes in the December quarter, but probably nothing more than you'd usually expect for an iPhone refresh. I think what's more significant is going into next year, when more of the features they talked about yesterday actually become available on the device, that you start to see perhaps more consumer interest and a bit more of a ramp up in demand. So it may well even be until we get the 17 next year before you actually see the possibility of a much bigger kind of super cycle and another kind of big smartphone race, if you like, about these new AI capabilities. And you're only really scratching the surface. You think about, the operating system they're rolling out, 18, is the first one that really integrates this kind of software and technology architecture. And so we'll have to see what the kind of the app environment does that takes advantage of these capabilities. And that's probably going to be a 2 to 3 year playbook, I think.
Talking about space, so this is quite exciting, although it was postponed. This is a SpaceX launch, which I think is the first, time that they basically, it's the first private walk.
That's
is that
right.
How you
Yes.
call it?
Private
spacewalk.
Non-professional spacewalk. Yes, a Polaris Dawn, which is this kind of privately funded mission for astronauts, commercial astronauts going up, and we're going to see 2 of them go on a spacewalk. It's exciting in lots of ways.
What is exactly a spacewalk? I mean,
so this is actually quite an interesting one because they're going up in this kind of Crew Dragon capsule. They're going to completely depressurize the capsule, open it up. 2 of the astronauts will stay inside the capsule. 2 of them will go out and do a bit of a spacewalk. Then they'll get back in and repressurize it. And part of this is about doing all sorts of scientific experiments to see how the human body copes with space, and that's really important for kind of longer distance missions to the Moon and Mars. And obviously they're testing this SpaceX spacewalk suit, which is going to be really important if we really are going to build space stations on the Moon and on Mars. You're going to have people outside in these environments. You need them to be wearing cost-effective and also kind of protective clothing. So this is the first big test of that suit. So there's lots of exciting things going on beyond just the fact that this is a spacewalk and it's a kind of privately funded venture.
So exciting. Matt, thank you so much. Matt Bloxham there from Bloomberg Intelligence. Coming up, the drama behind the AI revolution. We discuss the new book, Supremacy, by Bloomberg Opinion's Parmy Olson, how the visionaries of the technology are helping to consolidate power amongst corporate giants. That's next, and this is Bloomberg. Now, artificial intelligence continues to, of course, divide opinions. Some say it promises a path to utopia. Others say it could ultimately bring the collapse of civilization. Now, Supremacy, AI, ChatGPT, and the race that will change the world is a new book published today. It's quite exciting in the UK by Bloomberg Opinion's Parmy Olson. Now, it really delves into the drama behind the tech revolution and how visionaries like Sam Altman and Demis Hassabis helped consolidate power among corporate giants. Well, Parmy Olson joins us now. Parmy, I'm actually reading it right now, and I have to say it's a fantastic read. You pull no punches, it's to the point, and it's just smart. No other organization in histories have actually amassed so much power. I mean, it's incredible when you look at the figures of how Google and Microsoft are doing. And you focus on 2 pioneers, basically Sam Altman and Demis Hassabis, and how they sold out to these big giants. Why is it so important?
So, exactly as you said, these companies are, bigger than any empire that we've seen in history, whether it was the Roman Empire or any other company. They have such a big part of the market today. And what I found really fascinating about the AI boom is that it actually started the most recent boom with this real humanitarian effort. And it was led by 2 different guys on opposite sides of the ocean, Demis Hassabis, who was the founder of DeepMind, and Sam Altman, who was the founder of OpenAI. And Demis was the first one, actually, to pursue this crazy idea of building artificial general intelligence, which is AI that is as smart as or smarter than a human. And his view was, once we reach that, we can solve all sorts of problems. His motto was, solve intelligence and solve everything else. So he talked often about curing cancer and solving climate change, even unlocking the mysteries of reality in the universe, like really grand, ambitious stuff. And Sam Altman, also a few years later when he started OpenAI, he was saying, once we have AGI, we will be able to bring abundance to humanity. So his vision was improving the wealth of everyone on Earth, which is all very noble. But of course, what happened is building AI is incredibly expensive, as I think businesses and the markets have discovered in the last few years. And these efforts that both these men pursued ended up getting them sucked closer and closer into the center of gravity of these large tech companies, because they needed to align themselves with these firms to actually make these dreams come true. And of course, what ended up happening is the humanitarian efforts sort of faded away, and we now have a much more profit-driven approach to the technology, which is fine in and of itself. My concern is the regulatory vacuum that this is all happening in.
Yeah, and again, you explain it so well how big these companies are. So how threatening is it, the concentration power of AI?
Yeah, that's, I think, is what is so interesting, and we've seen it play out even in the last year. This concentration of power in AI is just increasing. If, for example, some of the most promising AI startups like Character AI, Inflection, and Adept, these are all companies that have raised billions and reached multi-billion-dollar valuations. And yet they've all been acqui-hired by the likes of Amazon, Google. And I think what this means is that ultimately this incredibly transformational technology, which is going to be more transformational in the next 5 to 10 years. I know there's been a bit of skepticism in the market about how much it really is going to improve profits and so forth. But it is my belief it is going to be transformational, is increasingly controlled by just a few players who are increasingly opaque. They are not transparent about how these algorithms work or the training data behind them. And they set their own rules as well. And what I found really interesting, and the reason I wanted to tell this story, is because it's an allegory for governance. Now, the whole topic of governance is incredibly dry, and people don't like talking about it. Like, regulation puts people to sleep. But in the story, well, sometimes, unless you really follow it well and you like to go down the rabbit hole. But in this case, both these men had their own efforts to create a responsible governance structure for AI because they knew early on that it needed to be protected. So they tried ethics boards, they tried nonprofit structures, and in both cases, those efforts failed. And so I tell that story of exactly how that happened, and I think it's a little bit of a red flag that even the people who created this, the visionaries behind this technology, knew early on that it needed responsible governance, and it just never actually happened.
Parmy, is that the price we have to pay for innovation? When you speak to a lot of these, tech giants, they say, well, we're doing a lot of things internally that actually will make it safe and better. And then they'll say, you can't regulate it too soon because then we'll never see the full potential of this technology of AI. Like, who's the right body to regulate it? Who's thinking about this?
It has to be outside the company. It just, self-regulation does not work. It only works to an extent. And it's certainly nice to see that companies do try to put in guardrails themselves, but ultimately, and as they should, they have a fiduciary duty to shareholders. And there, as yet, is no real regulatory framework for artificial intelligence apart from the European Union's AI Act, which hasn't been enacted yet. People are still unsure. Like, I've just been to Silicon Valley, and some of the startups and companies there are kind of complaining about the act because it's not specific enough. And they say, oh, it's just going to be a lot of bureaucratic nonsense. But, this is the kind of struggle that we're going through right now. And I think we do need to find that balance because exactly as you say, there's a price for all innovation. And that's what happened with social media. Mark Zuckerberg wanted to connect the world, but we also got out of that, in many cases, a mental health crisis, particularly for teenagers.
November 5th, we have a big U.S. election. Would any new president actually regulate or even break up some of these big giants?
Well, we know that there's certainly efforts going on by the FTC and the DOJ, and there's this whole antitrust case against Google, which is really moving forward, and there's talk now about Google potentially being broken up. There's two different views of that in Silicon Valley. Some venture capitalists really like that idea because they feel their companies are enthralled to big tech and are locked into using them as cloud providers and, in all sorts of relationships to build their companies. Whereas others say, actually, we want these companies to stay big so that we can have an exit, so that we can sell our startups to these big companies. So there's a real divide in the tech industry about whether that's good or not. But broadly speaking, yes, I think these companies do have way too much power.
Parmy, thank you so much. Well, for the book, it's, I think, my book of the year. I mean, we still have a couple of months left, but it's interesting, and you really bring it alive, actually, with, we speak about these challenges as kind of like, sometimes a little bit disconnected to the people that founded them. Parmy Olson from Bloomberg Opinion with her new book, AI, ChatGPT, and the Race That Will Change the World. Coming up, a deepening sell-off in Chinese stocks is intensifying a crisis of confidence in the world's second largest economy. We talk about China next, and this is Bloomberg. Record returns and now potentially a record glut. After outperformance for years, higher rates have resulted in over $3 trillion held up in aging, closely held companies. Now, opening trade anchor Kriti Gupta is live in Paris at the Ipem conference to break down the debate. Kriti, great work all day. So Mario Draghi talking about competitiveness. How's that being received on the ground?
Well, it's being received kind of well, actually, Fran. And this is really interesting because on the outside, when you have this report of Mario Draghi in Brussels and others, by the way, calling for investment in Europe, a lot of people are looking at that and saying, with what money, with what fiscal budget, when you're looking at some of the deficit issues in France, in Germany, and other parts of Europe as well. But here is where private capital is here to shine. The conversation on the floor is that this could actually work well for private investors looking to find spots of opportunity. Take a listen to what the head of Europe over at Apollo had to say on this. Rob Seminara commenting on this very dynamic.
We think this is a golden opportunity for private capital. We've been talking to date right now just about our private equity business, but if you look at our private capital and our credit business, it's $520 billion that we want to invest. And the nature of our capital, it's either in long-term locked-up funds or it's in regulated balance sheets, which are very long-term capital. And that makes us a great partner for corporations that want to invest long-term.
Rob Seminara there, the head of Europe over at Apollo, one of the major funds that are behind this drive in Europe. Francine, if there's no money from the public markets, no money from the fiscal governments, where does the growth come from? And he and some of the colleagues here at Ipem are making the argument that it actually comes from private investment.
So, Kriti, what kind of deals are actually happening in Europe, and how is it different from the U.S.?
Well, the thinking here is that you can't actually apply the same roadmap that you have in the U.S. to Europe. And a lot of that is the way that businesses are actually structured here. Now, we know the obvious, that the capital markets aren't as deep here. They're not as liquid here. And they're also not as efficient here as they might be in the United States. But that is where the opportunity lies. At least that's the commentary coming out of the likes of KKR, of course, managing just shy of $700 billion in AUM. This is a really big deal because take a listen to what Elisa Wood, a partner at KKR, had to say when it comes to where the deals are actually coming from.
If you look at where we're putting capital to work, 80% of the deal flow that we've done in Europe, the deals that we've invested in Europe in the last 10 years have come from these family partnerships, right? Yeah. That's creating a huge amount of opportunity where we can be a partner to those companies. The companies are focused on really one main thing. How do they grow? Right? How do they increase their operational alpha? Because that's the competitive advantage at the end of the day. And that's where the returns are coming from. Yeah. 80% of our returns are coming from growing the bottom line of our companies and being thematic investors, not riding interest rates.
80%, Fran, 80% of their deals are coming from family offices, basically these closely held companies, first generation, second generation wealth. They've been inherited and kept in the family for generations and for years to come across France and Germany. You have private markets, private investors coming in and saying, well, give us some of the float, give us some of the rights here to actually loosen a little bit of that liquidity. So now other investors, global investors, can take a share, can take stakes in what has been these companies held by, again, European families for such a long time. You see this in luxury, Fran. You have these conversations all the time. But now you're starting to see it in other places, in manufacturing, in industrials, even most recently for KKR in the satellite business out of Germany.
Interesting. Kriti, thanks so much for all of the hard work out there in Paris. Kriti Gupta there with the very latest on private equity. Now, a deepening sell-off in Chinese stocks is exacerbating a crisis of confidence in the world's second largest economy. The benchmark CSI 300 actually closed near its lowest level since January 2019. So let's bring in Bloomberg Markets Today managing editor Christine Aquino. Christine, it's so good to have you in London. Welcome. When you look at some of the concerns around the Chinese economy, it's really starting to hit stocks, but also just investor confidence worldwide.
Absolutely, Francine. I mean, that $6.5 trillion route, that's really going to rattle a lot of just consumers locally. And that really is the concern, right? Because China has started to kind of like move its economic model from being the manufacturer of the world to really focusing on its domestic population, which is massive. And the problem at the moment is that consumers really are just not feeling confident. And the issue here is really what that does to spending, what that does to kind of perceptions of inflation. In fact, there is a fear that China is now going to dive into a deflationary spiral as a result of just consumers not really having that confidence and not really feeling healthy at that moment.
And so you can feel that in commodities, for example, with the price of oil going down.
Absolutely, Francine. I mean, this is definitely a story that's being watched for commodities in particular, just because, you know, it's a big demand coming out of China here. And the fact that we have this economy that's really faltering at the moment, not necessarily seeing any signs of imminent broad support from Beijing, that's really going to do a number on that consumer demand there. And of course, you know, for commodities, oil specifically, we have other cross currents as well. What's OPEC Plus going to be doing in terms of supply? We know that there is a temporary kind of pause on that conversation, but, you know, that's going to return back to the radar probably toward the end of this year. And so it really is a commodity story that's starting to look very negative heading into the end of this year.
Yeah, and it's going to be tricky in the next couple of days because we have ECB and then Fed next week.
Absolutely, Francine. And, you know, I think this is definitely going to be at the back of minds of policymakers. Of course, you know, they're not really making policy for China. They're making policy for their own domestic economies. But when the world's second biggest economy is really seems to be just really struggling at the moment, you've got to be thinking as a policymaker, right, how do you mitigate against that, especially if there's a danger of a spiral?
Christine, thanks so much. Christine Aquino there, Bloomberg managing editor of Markets Today. Now, coming up, we also have live pictures from Cape Canaveral in Florida. SpaceX's Falcon 9 rocket waiting for liftoff after missing a potential launch opportunity over the past hour.